Have you ever found yourself stuck in this confusion? You work tirelessly from 9 to 5 every day, live frugally, and put every cent you earn into a fixed deposit account at a bank or post office, clinging to the belief that being debt-free brings peace of mind and saving money is the safest bet. Yet after a decade, while the number in your account has slowly climbed, your money seems to buy less and less. For office workers with a monthly salary of around $40,000, some remain trapped in financial struggle their whole lives, afraid to take a sick day even when unwell, while others manage to buy property and achieve financial freedom in just over a decade. Where exactly does this gap between the two come from? The answer may upend decades of your beliefs. The core difference between the poor and the rich is never how hard they work, but their perception of money. The poor treat money as a life, sustaining asset, clutching it tightly and depositing it in the bank, only to be legally plundered by the bank through a set of invisible rules, growing poorer the more they save. The rich, however, have long seen through this game. They treat money as a tool, borrow frantically from banks, use the bank's money to make money for themselves, and ultimately roll a bigger and bigger snowball of wealth. In Taiwan, once one of the 4 Asian tigers, this set of rules is tearing apart the region's wealth distribution in a shocking way. According to data from the 2026 World Inequality Report, the wealthiest 10% of Taiwan's population holds 61% of the region's total wealth, while the bottom 50% of the population holds just 4.3%. The top 10% of earners take home 48% of Taiwan's total income, compared to a mere 12% for the bottom 50%. At the same time, the median monthly salary for Taiwan's office workers in January 2026 was just NT $39,136, meaning half of all office workers earn less than this figure. The vast majority of them adhere to the mantra that saving money is king, yet they have no idea that their life savings are being slowly and completely eroded by the banks in a fully legal, yet brutally ruthless way. To uncover this truth, we first need to understand the essence of a bank. It is never a charity that helps you keep your money safe and make it grow, but a commercial institution that profits from the interest spread between low-interest deposit-taking and high-interest lending. This interest spread game is the most basic and core model of legal plunder used by banks. We can make this crystal clear with the most real interest rate data from Taiwan's market in 2026. Currently, the floating interest rate for 1-year fixed deposits at Changhua Post Company Limited is only 1.685%, and the 1-year fixed deposit rates at public sector banks, such as the Bank of Taiwan, generally hover around 1.6%. That means if you deposit NT $1 million in the bank will only pay you NT $16,850 in interest for a full year. And that's only if you don't touch the money at all during that period. But do you know how much the bank can earn in a year with your NT $1 million? According to the latest lending rates released by banks, including Taiwan Business Bank and Taiwan Cooperative Bank, the weighted average interest rate for new home loans from Taiwan's 5 major public sector banks generally ranges from 2.3% to 2.6%. In other words, when the bank lends out the NT $1 million you deposited in the form of a mortgage, it can steadily earn around NT $25,000 in interest a year. The nearly 1% spread in between is the first sum of money the bank makes from you without doing anything at all. What's even more staggering is that if the bank lends this money out in the form of unsecured personal loans, the interest rates for ordinary office workers generally range from 6 to 10%, and the revolving interest rate on credit cards can be as high as 5.96 to 15%. That means the bank can earn up to NT $150,000 in interest a year with your NT $1 million, while the return it gives you is a mere NT $16,000, not even a fraction of that profit. You think the bank is managing your money for you when you deposit it, but in reality, you are lending your money to the bank for free, letting the bank use your money to earn multiple times, even more than 10 times, the profit, while you only get a pitiful tip in return. This is the first truth. The banks will never tell you your deposits are the cheapest and most stable source of funding for banks, and the harder you scramble to save, the more the banks earn. If profit erosion from the interest spread was the only issue, it might not be enough to leave ordinary people growing poorer the more they save. The second layer of legal plunder hidden by banks is the invisible loss of purchasing power caused by inflation, a wealth eroding mechanism that almost no one notices yet has devastating power. Many people think that when they deposit money in the bank, earn interest, and see the number in their account grow after a year, they have made a profit. But they never do the math. The value of money is never determined by the number on the account statement, but by how much it can buy. In other words, its real purchasing power. According to the latest data released by Taiwan's Directorate General of Budget, Accounting and Statistics, DGBA's Taiwan's Consumer Price Index, CPI rose 1.75% year-on-year in February 2026, while the core inflation rate, which excludes energy, fruit and vegetable prices, was as high as 2.6%. This figure is exactly how much the purchasing power of your money shrinks in a year. Let's do the math again. With a $1 million fixed deposit, you put $1 million into a one-year fixed deposit at Chunghwa Post with an annual interest rate of 1.685%. And after a year, you get $1,016,850 in principal plus interest. On paper, you've gained $16,850, but calculated at the 2.6% core inflation rate, the purchasing power of money shrank by 2.6% over the year. That means the $1,016,850 you get after a year has a real purchasing power equivalent to only $990,850 a year prior. A total loss of $9,150. In other words, you thought you earned interest by saving money, but in reality, you not only made no profit that year, you lost nearly $10,000. Your wealth is being eroded jointly by inflation and the banks in a way you can't even see. This is why so many people have this feeling. A bowl of braised pork rice cost only $25 10 years ago. But now it's $50. A single-stop Taipei Metro fare was only $20 10 years ago. But now it's $30 10 years ago. $1 million was enough for a down payment on a house in New Taipei City. But now, it's barely enough to buy a parking space. Yet, your salary has barely increased in a decade. And while the number in your bank account has grown, the actual amount of goods and services you can buy with it keeps shrinking. The banks will never tell you that the biggest risk of fixed deposits is never bank failure, but the long-term continuous loss of purchasing power. In an era of low interest rates and high inflation, keeping all your money in fixed deposits for the long term is not wealth preservation. It's slow, hidden depreciation. The harder you scramble to save, the faster your wealth shrinks. At this point, you may ask, if saving money means getting eroded, why do the rich borrow frantically from banks? Aren't they afraid of paying interest or of being in debt? This is the core cognitive gap between the poor and the rich. The poor fear debt, see all debt as a scourge, and firmly believe that being debt-free brings peace of mind. The rich, however, can distinguish between good debt and bad debt. They never take on bad debt, but scramble to take on good debt using the bank's money to amplify their wealth gains. What is bad debt? It is debt used for consumption that generates no cash flow whatsoever and only forces you to keep paying interest to the bank. For example, using your credit card's revolving limit to buy the latest smartphone or go on an overseas trip, or taking out a high-interest personal loan to buy a car or luxury goods. Once this money is spent, it not only brings you no income, but also leaves you paying high interest every month, eventually trapping you in a vicious cycle of borrowing to pay off debt. Growing poorer the more you borrow. This is also the bank's favorite type of lending, because the interest rates are high enough to generate massive spreads. What is good debt? It is debt used to purchase assets that generate stable cash flow, with an annualized return that far exceeds the borrowing interest rate. This type of debt will not make you poor. It will act as an amplifier for your wealth, letting you use other people's money to make money for yourself. This is the core logic behind why the rich borrow like crazy. We can use a real case from Taiwan's market to break down this wealth amplification math, and you'll instantly understand the rich's money-making logic. Suppose two young people, both with $1 million in principal in 2016, both earning a monthly salary of $40,000, make two completely different choices. The first young person, a firm believer in the safety of saving, puts the entire $1 million into a one-year bank fixed deposit, set to auto-renew every year. Over the past decade, the average one-year fixed deposit rate in Taiwan was around 1.5%. After 10 years, his $1 million, plus compound interest, has grown to roughly $1,160,000, a paper profit of $160,000. But over those 10 years, Taipei Xingyi Real Estate Price Index rose 72.1% and cumulative core inflation exceeded 20%. The real purchasing power of his $1 million $160,000, not only didn't rise, it shrank by nearly 10%. The second young person, however, uses this $1 million as a down payment, takes out a $4 million loan from the bank, and buys a pre-owned house in New Taipei City with a total price of $5 million. The mortgage rate at the time was only 1.3%, and even with subsequent rate hikes by the central bank, the average mortgage rate was only around 2%, with a loan term of 30 years. His monthly mortgage principal and interest payment is roughly $14,800. He rents out the house for $18,000 a month, which not only fully covers the mortgage, but also leaves him with a net cash flow of $3,200 every month. 10 years later, even if the house price only rose by 50%, the total value of the property has gone from $5 million to $7,500,000. He pays off the remaining $3,200,000 loan principal to the bank, and still has $4,300,000 left. Combined with the cumulative net rental income of $384,000 over 10 years. His net assets reach $4,684,000, more than 4 times that of the first young person. This is the power of leverage. He used only $1 million in principal to leverage a $5 million asset, and all the gains from the rise in house prices belong to him. The bank only takes the agreed 2% interest, and he uses the bank's money to earn returns that far exceed the borrowing rate. This is the borrow money to make money game played by the rich. Ironically enough, the banks have also set up an extremely realistic, double standard in this game. The wealthier you are, the easier it is to borrow money at extremely low interest rates. The poorer you are, the higher the interest rate on the money you can borrow, and you may even be forced to only deposit your money in the bank and get eroded. Looking at Taiwan's bank lending rates in 2026, we can see that for wealthy entrepreneurs with substantial assets and borrowers with collateral, the interest rate on small and medium-sized enterprise SME operating loans can be as low as 1.8%, only 0.115 percentage points higher than Changhua Post's 1.685% one-year fixed deposit rate. That means the banks are practically lending money to the rich for free to make a profit. For ordinary office workers, however, the interest rate on unsecured personal loans offered by banks is generally above 6%, and credit card revolving rates can be as high as 15%, more than 8 times the lending rate for the wealthy. Why are the banks so biased against the poor and in favor of the rich? Because the essence of a bank is profit-seeking. It will always add flowers to the brocade for those who are already successful, and never send charcoal in the snow to those in dire need. When poor people borrow money, it is mostly for consumption, a depleting expense with no stable source of repayment, and an extremely high default risk. So banks must charge high interest rates to cover the risk. When rich people borrow money, it is mostly for investment, business, or buying assets, money that generates stable cash flow with sufficient collateral such as real estate or equity, and an extremely low default risk. That's why banks are willing to lend money to the rich at extremely low interest rates. This creates an extremely brutal Matthew effect. The wealthier you are, the easier it is to get cheap money, the easier it is to make money using the bank's money, and the wealthier you become. The poorer you are, the more you can only get high-cost money, or can only deposit your money in the bank to be eroded, and the poorer you become. One of the core reasons why Taiwan's wealth gap keeps widening is that this set of financial rules is constantly transferring wealth from savers at the bottom to investors at the top, and banks are the core intermediary and one of the biggest beneficiaries in this transfer system. If we dig deeper, we will find that the underlying logic of this legal plunder is the transmission mechanism of money issuance. The ultimate truth that banks and the entire financial system will never tell ordinary people. Many people think that when the central bank prints money and the money supply increases, everyone's money depreciates together. But in reality, newly issued money flows through the market in a specific order, and that order directly determines who gets to reap the dividends of economic growth and who gets eroded by inflation. In Taiwan's financial system, when the central bank adjusts interest rates and releases liquidity, new money always flows into the banking system first. After the banks get this money, the first thing they do is lend it to large corporations, wealthy asset owners, and listed companies. When these people get the money, they don't spend it on daily groceries or push up the prices of consumer goods. Instead, they buy core assets, real estate, stocks, land, factories, and so on. That's why asset prices always rise first. and the net worth of the rich doubles and grows in this process first. Only after these rich people have completed their asset allocation with the newly obtained money does the money slowly flow into every corner of the market through investment, salaries, and consumption. Only then do the prices of consumer goods start to rise, and inflation truly reaches the daily lives of ordinary people. By this time, ordinary office workers have just received a tiny salary increase, but prices have already gone up, and core assets such as housing and stocks have already risen to a level that ordinary people can no longer afford. Ordinary people can only use their already depreciated money to buy goods at already inflated prices, forever running behind inflation, never able to catch up with the rise in asset prices. This is why Taiwan's GDP growth rate reached 8.68% in 2025, a 15-year high, with GDP per capita approaching $40,000. Yet Taiwan's private consumption growth rate was only 1.35%, and the median salary of ordinary people has barely increased in a decade. Because the dividends of economic growth have long been fully captured by the rich who got the money first through asset appreciation. Ordinary people not only fail to enjoy the benefits of economic growth, but also have to bear the price increases brought by inflation, getting double eroded. And banks are the core valve in this money transmission process. They decide who the money flows to first, at what interest rate, and thus, who benefits from this set of rules, and who gets targeted for erosion. To this point, you may feel despair. As ordinary office workers, are we doomed to be eroded by banks, forever trapped in the fate of growing poorer the more we save? Of course not. We cannot change the rules of this financial game, but we can change our perception of money, turning from the ones being eroded by the rules to the ones using the rules. And the starting point of all this is to first break down 3 common financial misconceptions that have trapped countless ordinary people in Taiwan. The first misconception is that being debt-free brings peace of mind, and all debt is bad. As we said earlier, debt is divided into good and bad. Bad debt will make you poorer and must be paid off immediately. Good debt, on the other hand, is an amplifier of your wealth. As long as you can find assets with an annualized return higher than the borrowing rate, you can use good debt rationally to make money with the bank's money, instead of depositing your money in the bank for a lifetime and letting the bank make money with it. The second misconception is that fixed deposits are the safest, with no risk at all. In fact, there is no absolutely risk-free asset in the world. The risk of fixed deposits is not short-term volatility, but long-term continuous loss of purchasing power. In an era of low interest rates, keeping all your money in fixed deposits is the riskiest financial strategy because it will make you lose the purchasing power of your life savings before you even realize it. The third misconception is that I don't have money, so I don't need to manage my finances. I'll do it when I have money. On the contrary, the less money you have, the earlier you need to establish a correct view of money, and the more you need to understand how money works. Financial management is never the exclusive right of the rich, but a skill that every ordinary person should learn. You don't need millions in principle. You just need to stop lending your money to the bank for free first, get rid of high-interest bad debt, then slowly accumulate assets that generate cash flow, and use the power of time and compound interest to slowly roll your own snowball of wealth. If you always wait to manage your finances when you have money, you will never have money. For ordinary office workers in Taiwan, escaping the fate of being legally plundered by banks does not require a high degree nor a large amount of principle. It only requires you to make a few small changes starting today. First, immediately pay off all your high-interest bad debt, especially outstanding credit card revolving balances, cash card debts, and consumer loans with interest rates above 4%. The interest rates on these debts far exceed the returns you can get from any financial management, so paying them off first is the best financial decision you can make. Second, learn to calculate the real return on your money and stop being fooled by the paper interest numbers. Subtract the inflation rate from your deposit interest rate. If the result is negative, it means your money is shrinking and you need to adjust your asset allocation, instead of keeping all your money in fixed deposits. Third, learn to use low-interest good debt rationally to leverage assets that generate cash flow. For example, Taiwan's first-time homebuyer loans and youth entrepreneurship loans have extremely low policy interest rates. As long as you can find assets with an annualized return of more than 3%, such as the Yuanta Shares Taiwan Dividend Plus ETF stock code 0056, which has a long-term annual cash dividend yield of more than 4%. far exceeding mortgage rates, or real estate that generates stable rental income. You can use the bank's money to create passive income for yourself. Finally, and most importantly, establish an asset mindset, not a savings mindset. The poor scramble to save money, and in the end, their money becomes a profit-making tool for the banks. The rich scramble to buy assets. Assets are things that keep putting money in your pocket, such as rental property, dividend, paying stocks, or a profitable business. What you need to do is not work hard to make money for a lifetime, but keep accumulating assets that generate passive income. Let the assets work for you, and let money make money for you. In Taiwan's market, full of both opportunities and pitfalls, we see countless people every day who work hard and live frugally their whole lives, yet never escape the fate of being trapped by money. It's not that they don't work hard enough, but that they have never seen through the legal plunder game rules of the banks. They have worked for money their whole lives, but never let money work for them. The cruelest truth in this world is that you can never earn money beyond your perception of it. Every cent you earn is the realization of your perception of money. Every cent you lose is the result of a flaw in that perception. The banks will never tell you the truth of these rules, because only when you scramble to save, only when your perception of money stays stuck in place, can they keep making money from you and keep carrying out this lifelong legal plunder. What you need to do now, starting today, is to change your perception of money. Stop lending your money to the bank for free and learn to be the master of money, not its slave. This is the first step for you to escape poverty and move towards financial freedom.